Good morning, ladies and gentlemen, and welcome to the Vast Resources PLC Baita Plai Mine Plan Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via our Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Andrew Palia, CEO, Paul Fletcher, CFO, Craig Harvey, COO, and Andrew Hall, Chief Commercial Officer. Very good morning to you all.
Good morning, Paul. Good morning, team. How are you all? Thank you very much all for joining us for today's Baita Plai polymetallic mine upgrade development plan. I'll be going through the slides with Craig, Paul, and Andrew today, and we'll be presenting on each sector that is relevant for the presentation. I'll just turn off the cameras now so we can stick to the slides itself. I'll just go through the company overview first. We're currently listed on AIM, as most of you know, our vast ticker. The share price as of Friday was 0.11 of a P, with a market cap approximately 23 million, with just over 21 billion shares on issue. With us today, we've got our CFO, COO, and our CCO, Andrew Hall, who will be presenting throughout the presentation. As most of you know, we are focusing today on the Romanian mine plan and strategy. The vision is mainly focused on Baita Plai, but we will be talking to Manaila, Zagra, Blueberry, and others as well, but very limited as we only have an hour to discuss. As you know, Baita Plai, the new mine plan, was delivered in last week, and hopefully you've all had a chance to go through the presentation so to get a better understanding of it. But as I said, we'll be focusing mainly on Baita Plai today. I'll hand over to Craig now to go through the slides 6 and beyond to discuss what the new mine plan entails for the company. Thank you, Craig.
Hi, good morning, everybody. Thanks for joining us. So if we just run through these very quickly, a bit of the intro. It's a skarn deposit. We have stated that there's 8 distinct pipes. Currently, our mining activities are focused on the Antonio skarn, or the Antonio pipe. One of the near-term development targets is the Antonio North skarn. And with us being on the ground now in full force, the other pipes that we are having a look at, there's a whole bunch of names. It's called Nepomuk, Marta, Pregna, Sturzu, Vasile, and Baia Roshi. Now, these are all skarns that have been mined in the past, and depending on the level or how far you are away from the main shafts, they've been mined up to various levels between 6 level, 10 level, 13 level, and 15 level. Our mining activities are focused, as I said, on the Antonio skarn, which is down currently at 18 level, which is the lowest area of the mine. It's located in the Apuseni Mountains. If there's any geologists out there and you have a look about the Apuseni Mountains, you'll hear the golden quadrilateral. There's a couple of multiple world-class deposits that are situated in this range, so we are in a very good area. There we talk about Roja Montana, Roja Poieni, which is a very large open pit operated by the state at the moment. The sort of benefits that we've got is, yes, we've got an old mine, but there is extensive development. I mean, we are talking underground development haulages of in excess of 3 up to 5 kilometers in length across this ore body. So it's a very, very expensive mine. If we move on to the next slide. So dealing with the JORC resource that we drilled out and reported at the end of October 2020, this was done specifically to upgrade our confidence in our new mining areas. It has been through third-party reference and validation when we have been dealing with some of the third-party banks, so there's no issues around it. We've also stated that the exploration targets that we have, it's based on old historical info. Unfortunately, we have to, as a matter of course, we have to go and draw that out and follow the JORC principles. So we have many targets. You can see a couple of them there, and we have extensive drilling programs included in this mine plan that we're doing. If we move on to the next slide, some of the highlights of this revised mine plan, as opposed to the initial mining plan. I mean, it's pretty robust. We are planning to increase our mining capacity, and specifically our mining capacity, by up to 65%, and that is really driven exclusively by the move to a more mechanized mining method, and that includes these jumbos that have been ordered. It includes the LHDs, load haul dumper, or underground loader, scoop, for want of a better term. And we are moving away from the sort of labor-intensive manual methods, which is handheld drilling with air legs and the air jack legs, and compressed air loaders. Now, running a compressed air loader means you need 2 people on it. The buckets are very small. It's not a very modern piece of equipment, so therefore we are changing the mining method because we are able to. It's a lot more cost efficient and it's a lot more productive. We're also planning on introducing a XRT, which is X-ray tomography, I think it is. Excuse me if I've got it wrong. But what that effectively does is you can throw a bunch of ore at it, and as in any ore body, there will always be particles of rock or particles of ore that are not mineralized, and that comes out as dilution that has to go to the mill. It impacts your tramming capacity, it impacts your hoisting capacity, and what this XRT does is it views what the mineral densities are, in terms of things like lead, copper, zinc, gold, silver, and it determines what should be classified as a accept material, which is ore bearing, and what should be classified as low grade or waste, and it rejects it into a separate stream. By doing more, our hoisting in our shaft is limited, and I think in the questions, because some of those questions that have come through, what are our limitations, we'll deal with that in a bit more detail. But this allows us to, first of all, mine more and to fill the plant to its capacity with an upgraded ore product. We have had tests done by TOMRA. Initial indications are the ore is extremely or highly amenable to sorting, with upgrades of between 1.25 times up to 1.75 times. Now, in our plan, we have set it at a 1.5 times upgrade on the grade or the values. We've also introduced a dedicated expat team of expat managers that have been all over the world. You'll see a name mentioned there by the name of Marcus Brewster. So Marcus is on site. He joined us, I will get the day wrong, but early in March. I think it was about the 8th of March, around there somewhere, and he's on site at the moment as the general manager. We have gone further. We have made offers to a mining manager, a processing manager, a technical manager, and we are looking at bolstering the team with further mining supervision as such. On the funding, all of the capex that is required to do this plan is in hand. We have no further reasons to raise any further capital to actually purchase equipment or to do any of the rework on the actual mine plan. Clearly, as the funding from cash flows comes through, there will be additional equipment, and that will be acquired out of cash flow. One of the exciting things for me, being mainly a geo, is we are commencing a drilling program in June to target the down dip extension of the Antonio ore body. Our previous JORC drilling covers the area between 18 to 19 level, which underpins the plan for the first 3 years, the first 3 to 4 years, with a high confidence, knowing where the ore body is, what the grades are. However, we need to follow this up, and so we are now going to be targeting from 19 down to 22 level. And it's not based on throwing a dart at the dartboard. We do have historical info from old historical drill holes that indicates that the ore body continues. Some of the old info has logs, some of it doesn't. Some of the old info has grades, some of it doesn't. So we need to twin the holes and create new holes under the JORC code. And then in November, we are planning on drilling the Antonio North exploration target. And so all of that is included in this plan. It's all factored in. If we move on to the next slide, which is basically the profile of the tonnage. Now, one of the things that I want to share with you is, I mean, obviously that over there, that is the planned increase until we get to the capacity of the current plant, which is operating on 1 mole. The capacity of the plant there is at approximately 7,500 tons per month. We need to do a plant upgrade for completion in December, and basically at the same time, the XRT is going to be installed underground as well. Well, it's not going on surface, it's going on, is pre-developing for that increase.
Craig, hi. I think we may have just lost you.
Suddenly we're going to jump from 7.
Craig, apologies. We just lost you momentarily there. If you could just step back a few seconds, that'd be fantastic. Thank you.
No worries. So I'm not too sure where I was lost, but so that level over there is the level of the 1 mole in the plant. It is at 7,500 tons. We need to install a plant upgrade in December, which is approximately there, and the XRT is going to be implemented in December at the same time. Currently on the XRT, I've got a third-party independent mining consultancy designing the installation for the XRT underground, together with underground primary crushing and screening. So they are going to deliver that by the end of this month, and then we are going to know exactly what we have to do. That increase in that plan is driven by this pre-development. This period here is characterized by a number of working ends that are developing the ore body. So the increase from 7,500 tons to 15,000 tons can happen fairly quickly because we have a number of faces available that are essentially waiting for us to mine. Using the mechanized jumbo and using the mechanized loaders, It's very, very quick to actually increase. It coincides with the acquisition of our first long-haul drilling rig. This is where the mining converts from the initial new phase of a room and pillar into a long-haul open stope. A long-haul open stope can generate approximately 250 tons per blast per stope per shift. So we are going to acquire 2 of the long-haul rigs along with 4 LHDs, and that alone, those rigs drive approximately 21 to 22,000 tons on their own with that kit, with only that kit. So we are fairly happy and we are extremely confident that it can be done and can be achieved. If we move on to the next slide, which is now coming to the plant feed. The top graph is the plant feed. The previous one was showing the over mining that we are doing. So this is all that is accepted from the XRT, 60% and 40% reject. So it's about 22,500 tons mined, and out of the XRT you get approximately 14,000, call it 13.5 to 14,000. Excuse me. The first up to a point approximately about there, that is based on the JORC resource that we have drilled out. So the confidence in the tonnages and the grades coming out of that area are high. Going forward, what we have done is we have based the remainder of the plan on a 12-year history of the mine's operations. We have access now to plant processing records from 1999 up until 2012, and the grades that are stated in there, the copper grades of 1.27 and the zinc, the lead, the gold, and the silver, is the average of the feed that was sent to the plant. Now, clearly, if that's the average, 1.27% copper, if there were years at 0.9 or 1%, there were the corresponding years at 1.5s and 1.7s. So the history, in my opinion, in the absence of hard drilling data, is probably the best that you can go. So we know that we're going to be achieving something similar to that. On the bottom slide, we have a comparison there with the black line of the steady state production of the initial mining plan. And so that is at about 500 tons a month of copper. If you have a look at the blue line does this and it gets up to over there. So this is going to be steady state. You can compare that mill tonnage to that. That gap is 200 tons. So what we are saying is that overall, this mine plan shoots the lights out of the previous plan. There's a difference of 200 tons a month of copper concentrate. So in light of the current prices, in light of this revised mining plan, the revenues are going to reflect that. It's a build-up process, but as I say, this area here is based on a significantly higher confidence due to the JORC drilling that has been completed back in October 2020. On this slide, so this is a 3D model of just basically the underground workings. It's very difficult to take a 3D environment and put it onto a 2D picture. So all of this is going to be put into a 3D animation, and it's going to be uploaded onto the website in due course. It will have all of the scheduling. It will show which areas are being mined when. But as it is annotated on there, so all of the red, so these red colors here, those red colors there, that is the existing 18-level development that we are using. That's this one over here is a plan view, and that's a slightly more oblique view. This main decline, so this is the main decline that we actually refer to, which was always in the original plan, and it's still in the current plan, because you have to have a bottom access in order for you to handle your ore, because you mine in these areas and you have to drop the ore down and then it has to come out. So that's always been in there. What the difference with this new mine plan is, and I think I've drawn over it a bit now, but if you focus on that little area there, you can see there's a bit of a spiral, and that is what we refer to as a ramp incline. What that means is that it goes down at a gradient of about 12 degrees. That is the sort of rated gradient for mechanized equipment, these jumbo drilling rigs, the LHDs, and it ramps down to underneath 80 level, because that is the area that we drill. And so that purple block and that blue block are two different zones within the Antonio skarn. It represents the orientation of the ore body and where our block models sit. Now, that ramp incline accesses the first level, which we are going to be mining in a room and pillar type scenario, mining method. And a room and pillar generates tonnage very, very quickly, because you are basically carving out the interior of the ore. I was having a look at some of the mining efficiencies of the platinum mines in South Africa, and one that sort of stuck out to me, because I've been there and I worked there for a short while, was Two Rivers Platinum. Now, Two Rivers Platinum runs a belt incline, LHDs, and jumbo drilling rigs, and they mine their UG2 and the Merensky on a room and pillar method. They operate, and it's in one of the latest slides, they operate at an efficiency of 80 tons per TEC, which is sort of similar to ours, but it's higher. Our sort of efficiency that we're quoting is at about 63, and there's a reason for that. I have based all of these production rates on keeping handheld production rates. I haven't gone ahead and said, well, because we now have this new fancy equipment, we are going to flip a switch tomorrow and suddenly we are going to bat with the big boys that have been mining for many years and been using mechanized equipment. Because what we have to understand is that the mining industry in Romania, specifically the underground mining industry, has been dormant. So now it's like a child at Christmas. You give them a brand new toy, they don't know how to operate it, and they drive the remote control car straight into the pool. So we have a program of training. We are bringing in specifically a training company from Ireland to come and spend up to 6 months on site with dedicated training supervisors, that at the end of the day, the workers at the mine that are identified as potential operators are going to go through a training program and be certified by this company at the end of the day. So a lot of the production rates that we have got in here are not utilizing the capabilities of what the machines can actually do. So in my opinion, I do think that this plan is extremely achievable. There's nothing that should stop it. If we move on to the next one, what does all of this mean? It means that basically we are looking at a 21% reduction in mining cost, or in a total cost per mine ton, and that is driven by efficiencies and by volume, because very quickly we are going to be in a position where we can increase the volume. One of the graphs that I want to just highlight at the bottom left is what I was talking about earlier. It's tons per TEC. So TEC is basically employees. It's the total amount of people on the mine, from the general manager to the office cleaners at night. It's everybody that is costed and paid a salary by the mine. So in the initial phases, you can see what starts to happen. It goes there's a jump as you convert to the first longhole stoping. As we get the second longhole stoping going, it jumps even further. And we are looking at maintaining an average of about 60 to 65 tons per TEC. Not a lot of companies report it. It's very much a South African thing, but we are still below what some of the mechanized mines do. I'll mention some of the platinum mines. One of the platinum mines is running at about 180 tons per TEC, just to give it a bit of color. I think if we move on to the next slides, I think this is going to be for our CFO to have a look at, and he can take it further.
Thanks very much, Craig. Good morning to everybody. The net revenue numbers and the cash before debt, tax, and capex you're seeing there were stated on the previous slide, so that's identical. But what that's highlighting is obviously revenue ramps up quite quickly. Year 2, year 3, we're really getting into steady state. The cash flow before debt, tax, and capex, that's an operating cash flow number. Clearly, in the first year, that's going to be lower, but as we ramp up volume, we close the gap and contribute straight to the bottom line. To give you an idea, a little bit of variability and to kind of allude to what Craig was saying, that initially the startup, you can see it is there on the cash flows on the monthly basis. We have the ramp up, and you can see how that progresses. We have, as Craig stated, we have the cash to do the capex, and from future cash flows to contribute to the capex as we develop the mine out and get the new rigs in and increase capacity, the mining capacity. We are net deficit to begin with, but that is covered. The OPEX is covered as well with our cash position at the moment, and also the forward-looking cash flows. The key point is, I guess, is the investment, the capex investment. It is substantial, and particularly with reference to other capital equipment. And that phases in as going back to one of the charts that Craig was talking about, that aligns with the increase in mine production. So obviously we get more rigs in and we increase that capacity. So it's a pretty big number. The other important factor, there are two important factors there. The drilling program that continues and that kicks off in May. So we're still looking to get into that to that exploration target. So that's all funded. And then finally, there's a cement backfill plant, which this is important, and it comes later next year. But the point of this investment is that we can use the waste rock, we can add some ingredients to it to make a cement-like substance, which then goes in and backfills, and that's environmentally much better, and it's also much safer underground. So the key points really on this particular slide is that we got good cash flow generation, we got good capex, and that obviously appeals to is good for refi. And I haven't addressed on these. We're talking about before debt servicing and debt repayment, and obviously the refi is the key objective of ours in order to finance our Atlas, who has been and continues to be supportive of our position. So moving on to the next slide is a much more detailed slide, but I mean it is giving cash flow projections corresponding to what you see on the previous slide, and corresponding to the mine plan over a 5-year period. It's done half yearly. We've decided to get those reporting buckets to coincide with our interim reporting and our year-end reporting, not in terms necessarily obviously of timing, but just to coincide the reporting periods, and that's how we'll monitor the progress against that plan. And obviously, if anything departs materially for that in that period, that's obviously something that we have to disclose to the market. The plan itself will be fluid. I mean, after as Craig was mentioning, there's, in terms of progress, if we're going at the manual rates, but if we improve those rates, the plan will be different. And obviously, looking to the upside, that's going to be a good thing. So there's obviously a period where we will have to continue to revise this period, and I think a 6-month period is to get track record is probably the optimum time in order to collate information to do that. The other important, again, which Craig mentioned, was the JORC grades that were published. They're included in here, and they're all factored into the mine plan, and obviously the revenue generation from therefrom. From February 2024, we're using the in-situ grades, which Craig was referring to. Moving quickly on to, there's a lot of small numbers on there, but this third slide, or this slide 15, is the primary objective of this is to compute an NPV, which is done on annual cash flows and annual discounted rate, and which is described. I mean, the sensitivities around that are described in the RNS that was released. But also to be very transparent about what's driving those particular numbers. So there's some key assumptions in terms of in situ grades, the feed grades after dilution and concentration by the XRT. Obviously, there's some ore loss from that process, but you end up with the feed grades that are quantified here. And you can see the pricing, and again, we've in the RNS we did a little bit of sensitivity analysis around that. So that gives a ballpark figure around 100 million tons of valuation, which we believe it to be a floor, because there's a lot of potential upside. We believe there's a lot of potential upside on this particular project. We have there's potential in increasing the resource. There's clearly potential in increasing capacity. We've obviously done increased capacity under this new mechanized mine plan, but there's more scope to do more. And the quicker you can mine this stuff, the more you can bring the cash flows forwards, and the quicker you can bring value to the shareholders in terms of share price. So we do think also there's a possibility for, and it's all subject to drilling, but for grade improvement on what we have. And finally, there's bullishness in copper. We think we're here at the right time, and other knock-on effects, which if we successfully execute this particular project, then it opens up the possibility for further assets in the pipeline. So just passing that on then to Andrew Hall now, who will talk a little bit about
thanks, Paul.
Management team.
In addition to the new general manager hire that we made at the beginning of March, to further reduce execution risk, we've now identified and will be bringing on board a new underground mine manager who will start this month. We have identified a processing plant manager who'll be joining us in May, along with a mine technical services superintendent. And so these sort of key hires, in addition to Marcus, and in addition to the consulting firm who we're bringing in to aid in sort of training and development of the local workforce, is going to be a big part to play in really this reduction of execution risk. We can move quickly on to the next slide, given the timing to get to the Q&A. Paul?
Sorry about that, we're fighting over the slide. I mean, very quickly, various mitigants to these risks, ordering the equipment, reputable suppliers, in cases where we're ordering again, they're tried and tested. Project management is obviously a very key risk to address. And that's by, as Andrew was mentioning, with the new team in place, highly experienced expat team, and to provide the leadership and supervision and training coming in with supplier equipment. Labour resources, skill shortages, always more of a problem before, less so now under mechanization, clearly because of the efficiency, ore availability and production schedule delays. I think Craig has really alluded to some of the potential not slack, but the potential room we have in the plan, and mechanization reduces those inherent risks, and finally commodity price movements. We don't. What's important with one of the previous slides, you can see the margin is very healthy versus our cost base. So and also the diversification in our commodity portfolio because of high government credit offers some protection. So it's not something that we hedge, and we don't think we will have to hedge, and maybe later down the line when we have more stable production, that's something that we can think about in the short term. But as I said previously, one of the points that's attractive about the investments is obviously the view on pricing of these commodities. So moving on to slide 18, I think, Andrew, that's you again. Craig.
It's Craig. So just very quickly to give everybody an idea, this is a diesel LHD that we are bringing in. It should be in April. Here we have slightly larger LHDs. The red reel at the back is a electric cable reel arriving April, probably end of April, beginning of May. This is one of our key things that we're having a look at getting. Well, not at getting, it's being manufactured by Aramine in France at the moment. And then this is a long hole stope drilling rig. It can drill up to 15 meters and that pulls a fan. As you can see, acquiring in November 2021 and then in the second phase in August 22. The XRT is just a visual representation and a quotation that Tomra has given us. Shows a very clear amenability for the ore to be separated using Tomra's XRT, X-ray transmission. Sorry, there we go. There's the right word. And so we are doing further tests just to refine and throw in different types of material, copper rich, copper poor, during the test phase. Thank you.
That's great. Thank you very much indeed to the VAST team for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of the screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that recording this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order the company can better understand your views and expectations. As the slide said, let's move on to the Q&A. The purpose of today's session is to really address questions that have risen as part of the publication of the new mine plan for Baita Plai, which was announced on the 30th of March. The company has also received a number of questions relating to the wider portfolio and general strategy, and we'll look to answer as many of these as possible during the allotted time we have today. Due to the volume of the pre-submitted questions, along with those of today's meeting, we may not be able to cover every question that we've received. However, the VAST team will review all questions submitted, and we'll look to respond to these in writing in due course. And obviously, we'll prioritise those questions where the themes have come up most frequently. The VAST team would also like to remind current shareholders and new investors they're not permitted to discuss any information which has not been previously announced to the market and which could be deemed as price sensitive. Instead, they will look to provide colour and context around previously announced news or clarity on items where required. Let's start then with our main focus, which is Baita Plai. Perhaps, Andrew, I could hand over to you, please.
Thank you, Paul. Due to the time restriction, the inundation of questions, I'd just like to say that we'll address as many questions as possible, and what's outstanding we'll publish separately. The main line of today's questioning is on the mine plan itself, related to the timing, and specifically why the mine plan wasn't implemented from the commencement of operations in October 2020. We'll pick up on these questions individually. However, we would like to point to various developments that affected our ability to operate as previously assumed, such as labour issues, stability of the working areas, and equipment availability and reliability. Further work which improved our understanding of the mine, most notably the JORC from the drilling of September 2020 and the review of historic data in Antonio North during November 2020, contributed to this decision to make the changes in the mine plan. It was really a combination of these issues, together with the performance of analysis of budget versus actual that was published in September, I think September 7th, 2020, were done prior to operations commencing, which prompted the review of the new mine planning strategy, which we've now released in February 20. And that was done upon Craig's return to site. I'd like to hand over to Craig to answer the first set of questions specifically related to the technical part of the questions in the mine plans itself. So please, Craig, take over. We're limited on time. We've got 50 odd questions, so we'll run through these as quickly as possible. Thanks.
Fantastic. Thank you very much indeed, Andrew. Craig, just turning to the new mine plan questions. The first one we had here is why wasn't the new mechanised mine plan highlighted in previous audits and reviews when Vast were initially awarded the BP licence?
Thanks, Paul. So basically the new mechanised mine plan is as a result of increased understanding of the ore body. There was always a mechanised element involved. However, our plan was to mine out a remnant area sitting between 17 and 18 level. This is the area that we actually started mining in, and it was using conventional methods, so conventional handheld, conventional pneumatic air-powered loaders. And we kept the old way of mining because it's very difficult to change a mining layout. So that was always going to be, that's where we were going to start first. The problem came in is that this mine has been standing for 9 to 10 years. As soon as, well, not as soon, but as we started increasing activities in the stope, it became very clear that the stability of those historical stopes was not very good. As we started to take more and more blasts, we started to notice that some of the pillars that were left they had started to crack. And from a safety point of view, you cannot throw more and more people inside these stopes. So based on that, that's sort of the real reason. As Andrew said, I mean, with all of this COVID travel issues and whatever, I managed to get back to the mine at the end of January, and it took a week. And I just said, look, there's no ways that we're going to carry on mining like this, and we need to limit the amount of people that can go into those stopes, which we did. And we sat down and we had a look at what the various options were, and that is where this new mine plan has actually come from, and it has come out really from all of the drilling that has been completed, and sourcing the right sort of equipment that we can put in. I can allude to some other things in some further questions around some of our constraints. We have very, very small shafts, but this mining method it's a tried and proven combination of room and pillar and long hole open stoping. So in a nutshell, it is mainly due to safety. If we cannot mine safely, we shouldn't be mining at all. So I'll leave that question at that.
Thank you, Craig. The next one we've got here, I guess, touches on that. Is why was there a delay in realising that the bridge was not strong enough? Okay,
yeah, Paul. So on first look, it appeared to be fine. However, as soon as the 5-ton diesel loco went across the bridge with some hoppers, rail wagons in it, we obviously noticed that things were not right. So what we did is we stopped, we closed the area off, and we went and we did what we had to do. It's an oversight of the management on site. We acknowledge that, but however, it's been fixed.
Thank you. Next one reads as follows. What was the reason why the old method could not achieve what was stated in the old mining plan?
Okay, so basically the real fundamental issue is, just as I have said before, the issue around safety for any mining company is at the forefront of every decision that you make. If you're going to mine, and you're not going to mine in a responsible manner and in an unsafe manner, you shouldn't be mining at all. Unfortunately, initial looks or initially investigations to the mining area at face value looked fair. With the increase in blasting activities and the increase in shock waves that you introduce into the remnant area, we noticed that pillars were beginning to fail. So we had to not stop that, but limit the amount of mining that takes place in there. So we are currently still mining there. However, we are busy with this new plan. We also did have, as any mining company will have, we do have some skilled labor shortages, equipment reliability, and this is one of the reasons to also moving towards more modern equipment. Yeah, I think that's basically it.
Thank you, Craig. Next one we've got here is, how much is the new mining equipment? When will it arrive and when will it be installed?
Okay, I think that is in the presentation on page 13. It's a total of about $4.5 million. All of the schedules of when the equipment is coming on site is in the presentation as well.
Thank you. Will installing the new kit cause any production downtime?
There'll be a limited effect on it. It will probably stop hoisting for one shift because it's got to go down the mine. Once it goes down the mine, because it's going to go down in a disassembled state, and it's going to have to be reassembled underground. So this is all factored into our plan. We are currently still mining in the old areas on a limited scale, but it won't cause any significant production downtime, no.
Thank you. What level of production has continued whilst the mining plan reassessment has been taking place?
Okay, so I mean, we've answered a lot of this already. So we are carrying on at a limited scale, and we are focusing heavily on getting the new access to the ore body below 18 level. As I said, I arrived late at the end of January. During February, we sat down as a team and we went through what the options were. We pulled the trigger for the new plan in March, and the specific, that spiral ramp incline, just to give you an idea of what can actually happen, is the budget setting the new plan for the advance of that end was 36 meters, and we achieved 42.4 meters in March. So I'm very, very happy, and I'm very proud of the guys that are at the mine, because they actually pulled finger and they did a really good job. I just want to point out a couple of fundamental changes when I talk handheld drilling and jumbo drilling. So when you're doing handheld drilling at a working face with a air-powered air leg, you need two people to operate that air leg because it's fairly heavy and it's unwieldy. So you need one guy to operate the air leg, and you need a guy to lift up the drilling steel, which is the 1 meter long jumper, we call it, and put it against the face. So at any face that you drill, you need two people. If I put in that Aramine jumbo drill, I only need one person because it's one operator. It's all hydraulically electrically controlled. So that's great. In addition, the jumbo drill can drill more faces. So a handheld drilling penetration rate is typically around 300 mils per minute, 0.3 meters per minute. A jumbo drilling penetration rate, it depends on the drifter, we call it, that you've got on the rig, but our drifter can do between 1 to 1.5 meters per minute. So it's typically, what is that? Three times more. Now that time that you gain, you don't use the jumbo just on one face. That jumbo can now draw between 3 and 5 faces in a shift. So very, very quickly, handheld that only advances a 1 meter hole, and the jumbo drills between 1.8 to 2.2 meters. Very quickly, I am drilling 3 times more working faces with 1 employee instead of 6, and I'm advancing 2 times more on each blast. But now, as I have alluded to, in this plan, on the production rates, I have kept it at the handheld production rates. So I haven't gone ahead and said the equipment's going to arrive and we're all going to be stars and it's all going to function perfectly. I have kept it back. So I'm very, very happy that we are going to be able to achieve this plan.
Thanks. Next one we've got here is, based on the figures providing the latest RNS and increased copper prices, it confirmed the original plan was pure fiction, was never achievable. Similar happened in Manaila. Someone needs to take ownership of these mistakes. If you've got a comment on that, thank you.
Well, calling it pure fiction, I think, is a bit harsh. It's based on information that we have to hand. As I have stated before, if we cannot mine safely, we're not going to mine at all. It's a fact. Unfortunately, worker safety is paramount. What we have done is we have identified these issues, we have taken action, and we have, in my opinion, bettered the plan with the introduction of the mechanized equipment and the introduction of the XRT. It allows the plan to generate extremely healthy cash flows.
That's great, thank you, Craig. Why have you not specified what has been achieved to date against the old mining plan? This comparison allows greater scrutiny to previously published figures.
Okay, well, just on that, the two mining methods are sort of very, very different. But what I can say is that on the old plan, October and November went and proceeded according to our plan. December could be my fault. I put it down to silly season. Production was up, but it wasn't where it should have been. Alarm bells began to ring in January, and hence I jumped through a whole lot of hoops to get the right to go back to Romania, with the lockdowns and restrictions in South Africa and Europe and transit and that. And very quickly, we have taken remedial action in February. Thanks, Paul.
Thank you very much indeed there, Craig. And perhaps I can now move on to some questions around offtake and perhaps one's for you actually, Andrew, if that's okay.
No problem.
The first one we've got here, the first shipment container posted on Twitter had numbers blurred out. Was this just to satisfy Mercuria after what happened to them, as it just looks suspicious to shareholders in the wider market?
Yeah, so nothing suspicious. The numbers were blurred out because of confidentiality that we have with Mercuria. We transport the containers from Baita under supervision by Mercuria to the port of Constanța in Romania, and then Mercuria takes control of the containers of concentrate.
That's great, thank you, Andrew. How often do we make copper concentrate sales to Mercuria? To date, how many have been completed?
We have ongoing production and ongoing sales. We can't give information regarding those sales to Mercuria outside of the planned sales and production reporting. That's just the policy.
Thank you. Next one reads as follows: how can shareholders be sure under such secretive offtake conditions that the company is receiving the best possible or most competitive prices for the concentrate that we produce?
So we secure funding from Atlas, and really Atlas, in the same way any lender is not going to move forward with a transaction if the offtake is not in line with market pricing. Our offtake agreements are all benchmarked against LME. The only real difference are the costs of tolling and refining charges and penalties for quality. The variation between off-takers, given our current levels of production, is going to be minimal, but it's something that we review on a regular basis.
And finally, I guess follow on to that, is the company able to get better value for concentrate elsewhere?
That will certainly come as production increases. We'll be able to, with anything, as volume increases, you can take advantage of better commercial terms.
That's great. Thank you very much indeed. Next is a grouping of questions really around reporting. Perhaps Paul Fletcher, if I could just turn to you, please, that'd be great.
Sure, Paul. Yeah.
Right, the first question we have here is, can you confirm your planned reporting strategy for Baita Plai Will you report monthly, quarterly, or 6 monthly? And what will you report? The second part really reads on, given the current share price, how do you think such reporting could be used to improve the share price?
Yeah, I mean, as I alluded to when I was going through the slides, we're going to be reporting on a 6 monthly basis, a period of 6 months, consistent with interim and reports. Obviously, will be much more timely on than we would have to go to the market with those published reports. We'll do productive data, and we'll give key financial information, performance, cash flow information when we do that.
That's great. And just to follow on really here is, please explain the reasoning behind the 6 monthly reporting schedule.
Several reasons. One, to coincide with what we're publishing to the market as interims in terms of period, not in terms of timeliness of the data, and also the year end. What we found also is that when we're discussing with financiers, there's obviously an interest to roll forward from these published data points. And so it makes sense to integrate everything and report everything over the same period. The second thing, and to focus everybody on the same reporting timelines and deadlines. And the other factor is obviously that it gives you a period where you can get some track record. You're going to have some volatility. 1 month's going to be better, 1 month maybe worse, or whatever. So you want to get some track record, but that doesn't detract from our requirement if we are going to be materially missing anything or overperforming on something. We will obviously need to go and update the market.
That's great. Thank you very much indeed. The next pre-submitted one we have here is, understand that you cannot report monies in from Baita Plai sales, but could you at least report the amounts mined/sold?
We'll do that as part of the 6 monthly reporting process.
That's great, thank you. Next sort of grouping of questions we've got here, again, I think for you really, Paul, around the AP group.
Yeah.
We've had the BP license for a number of years with various professionals evaluating the mine. Therefore, why was there the need for further specialist equipment only identified at BP earlier this year? Was this purposely hidden so the AP group didn't have to stump up their 20% of costs?
No. And as for the first point regarding the equipment, I think that's been addressed by Craig and the other talkers, the other presenters. Obviously, that was a new mine plan. The circumstances around that have been discussed. In terms of the AP group, I mean, AP group acquired Baita, and then subsequently, VAS came in and bought 80%. And we've always been in this position where we have a potential conflict of interest because there are certain directors who are part of that 20%, and so there's if you like, potentially on paper a misalignment of interests in versus the rest of the company. So it's always something that the company's been very aware of, and the market's been very aware of, and something that we wanted to change. And I'm very happy that we did change it, and that we've aligned those directors' interests on paper. They always were aligned, but I mean, we've aligned them on paper so they have the same interests as shareholders. What accelerated that perhaps was the discussions with the first tier bank, because it was a condition precedent and something they wanted to see, and that's completely removed from any well before we had the issues, identified the issues at Baita Plai, so they're totally disconnected.
Thank you. The next one we've got here is a little bit longer, but in relation to the acquisitions of APMG, the company's qualified non-related parties overlooking the transaction for the benefit of shareholders initially failed to include a lock-in period, allowing the possibilities for all shareholders held by the related parties to be dumped from day one. Did the qualified non-related parties deliberately fail to include a lock-in period for the benefit of friends of the board, or did the qualified status allow them simply to forget to include it?
Well, the first point is that any disposal of shares by a director have to be announced to the market. So, I mean, clearly, if you're disposing, you're gonna. It's not good for the shares. It's not good in terms of what you're messaging and what you feel the value of the company is. So. Clearly that wasn't the case. These individuals that want to be in for the long term, and their interests are aligned with shareholders. As soon as this came up and some shareholders mentioned it, the formal lock-in period was put in place.
Thank you there, Paul. Penultimate one, I think, for you really here is why after did the non-related partners only lock in circa 60% of the shares involved in the transaction as opposed to 100% of the shares, given that the other 40% clearly belonged to the sons of the related parties, whose names had only just recently appeared as directors of APMG?
Okay, I think this is referring to related parties, not non-related parties. Couple of things here, and if people want more information, because there's a lot of information in the RNS issued on November the 6th, and there's an extract from the chairman, a letter from the chairman. Couple of things here: the sons of the directors at no time were directors, and I think so. There's been a misinterpretation there, because there is reference to a former director who obtained shares. But left quite some time ago, left the company quite some time ago. So this 60% that's referred to is actually 20%. And just to correct the statement, that the sons of the directors were at no time have ever been directors.
That's great, thank you, Paul. The final one, I guess, just follows on from that, is has that 40% been dumped?
And that 40% being, I think it's actually 20%. It's not 40%, it's 20%. I don't know whether I explained that previously, but that's held, hasn't been sold. So no, hasn't been dumped.
Fantastic, thanks, Paul. Now, perhaps move on to some more general questions, which I guess more for Andrew and Craig. Perhaps the first one I can direct to you, please, Andrew. Is there any external interest in Baita Plai, such as a potential takeover target, given the current market cap, infrastructure value, and copper price?
At the moment, no, there hasn't been none that we've been made aware of. You've got to put things into perspective that many of the majors, in fact, all the majors have tried to enter the Romanian market, and Baita being a success is actually a benchmark. So at this point in time, no, we've had plenty of discussions with majors about the portfolio in Romania, and all eyes are on Baita being a success story, which is part of the reason why we've expanded the mining method and accelerated the plan. But at this point, no, there's been no takeover. It's too small for the big ones and too big for the small ones.
That's great, thank you. Next one, again for you actually, there is, when do you anticipate having the new experienced BP management in place? Do you have candidates, or has the recruitment process only just started?
Well, other than Marcus being hired, we've now identified and contracts have been issued, or I think signed, for the underground mining manager, who actually comes on site, I think later this week or early next week. The processing manager will be on site in early May, and I believe a mining superintendent's been identified. But all of the posts have been now identified, and we will announce the identity of those hires, but they'll all come with vast experience, pardon the pun, and they'll be on site before the new infrastructure's installed.
Thanks, Andrew. And the final one from you, I think, before we move on to Craig, is the company has spent the past 3 years reinforcing the idea that Baita Plai is a company maker, a cash cow, and an Aladdin's cave. However, since the acquisition of AP Mining Group, not once have I heard the company talk of Baita Plai with such positivity. Is there any particular reason why?
I beg to differ. I mean, we've always confirmed and reinforced the fact that we do believe in Baita, and the extent of this mine plan is basically just to prove that. Now that we're in production and we've just completed the mine plan, we're commencing the further drilling campaign in May and again in early 22, which will further underpin the, let's call it the Aladdin's Cave theory. We are getting good results out of what we're mining at the moment, even though the area of 17 and 18 was not included in that JORC that was published in September last year. So that was a remnants of the old working areas. With access into level 19, we'll see a substantial increase in the grade. And then once we finish the drilling campaign in June, I think it is, for under 19 to 20 to 22, we'll be able to announce that as well, which will increase the JORC resource. And just to add, somebody mentioned that, you know, we always refer to it as measured, indicated, inferred, but we've only got indicated and inferred. it's actually just a figure of speech. It's the way that you report. It's not something we're trying to mislead the market with. And then above and beyond that, we've also got other minerals in there, such as molybdenum and bismuth and tungsten, which we also intend on monetising in the future.
Thanks, Andrew. Craig, if I can move on to you, we've got a question here that's sort of got multiple questions in it, but let me just read it out as follows, and please give your answers where appropriate. The company has failed to provide the basic information needed in order for shareholders to get a true understanding of the Baita Plai asset. From the simple layout of the operations to the processes involved in those operations. For example, from the point of extraction, how far does the ore need to be transported before it exits the mine? Is the process of transporting that ore to the mine exit efficient? Where are the adits? How restricted are the underground galleries? And where do any potential issues lie, where space could become a problem in the future? How does the ore then need to be transported to allow it to be processed? How many locomotives and carriages does the company have? How many fully loaded carriages can the locomotive safely transport? Can the rail network at Baita Plai even operate with more than one locomotive on its rails at once? These are just a few examples. Will the company commit to uploading to the company website the interpretable layout of the mine, the operations, including locations of key infrastructure, layout of the rails, a clear layout of the underground galleries, and in relation to the service features, and anything necessary for a better understanding? And I can appreciate there's sort of multiple questions in there, Craig, but if you could just give your answers where appropriate, that'd be great.
No, thanks, Paul. I think let me just sort of give an overview of most of it here. So the mine is currently operating on the lowest levels of the mine. It's level 17 and 18. In terms of depth below surface, the workings are approximately 500 meters below surface, but this varies because obviously we've got an undulating topography within the region. The current mining area, as we have spoken before, is a remnant stope between 17 and 18 level. The ore mined inside that stope is transferred down to 18 level through internal ore passes or ore tips by means of a manually operated pneumatic air loader of the air loader's bucket capacity 0.18 cubes. It's quite a small little thing. The ore is then loaded from the internal ore tips into hoppers or rail wagons of 0.8 cubic meters in size and transported by locomotive a distance of approximately 500 meters to the number 3 shaft, the number 3 vertical shaft. The hoppers are then hoisted by means of a single deck cage to 13 level, where the hoppers are transported a further 300 meters to the number 1 vertical shaft, where they are then hoisted to 0 level by means of the single deck cage. So just on that, we do hopper hoisting. So there's no shaft tips or shaft ore passes. The ore is then on 0 level. It's discharged into surface tips, which run from 0 level down to 6 level. There's 3 of them. They each have a capacity of approximately 200 tons. The ore is then drawn from those ore passes into 3 cubic meter surface rail wagons, and it's on our 6 level elevation. And they are transported by rail a distance of approximately 900 meters to the ore tips and silos at the processing plant across the infamous bridge. In terms of equipment, so we have a 7-ton overhead electric trolley loco on 18 level with a spare, a 5-ton battery loco on 13 level, a 2.5-ton battery loco on 0 level, and a 5-ton diesel locomotive for surface trim. We have 60 fixed position rail wagons in the mine, which we use for ore. And fixed, it means they don't swing. We have 30 swing wagons in the mine, which we use for development waste. And we have 10 of the 3 cubic meter rail wagons on surface for the transport from the mine to the plant. In terms of constraints, I mean, really what this mine plan and probably what was one of the constraints when we were devising the initial mine plan is the actual size of the shaft. And as I said, we do hopper hoisting. So what that means is that each hopper is loaded into the single deck cage and hoisted up. So that's what we can hoist. That's it. The shaft is a dual compartment shaft. It's got dimensions of each compartment is about 1 meter wide by 1.9 meters long. So all of this equipment that we're getting, specifically the Aramine jumbo and the long hole drilling rigs, these are very special items. So they are ultra narrow vein mining equipment. The Aramine rig can fit down the shaft when it's disassembled down to its axles with the hubs taken off. That puts it at 1 meter. Sorry, and I did say that the compartment size is 1 meter. The one compartment is 950 and the other compartment is 1050 mils. So it can fit down one of the compartments, not the other one. So it's a very, very specialist piece of equipment, which has been very difficult to actually find in source. I mean, there's lots of equipment out there. It's just too big. In terms of the hoisting in the actual shaft, one of the constraints that we have, I mean, we do have options. A very simple way of doubling your hoisting capacity is to move from a single deck cage to a double deck cage. There, you know, not one hopper, but 2 hoppers at a time. However, this comes with its own issues. The winder would need to be upgraded, the winder motor, because you're going to be pulling heavier weight, double deck cage plus 2 hoppers. The ropes are going to have to be upgraded. The braking system is going to have to be upgraded, and the instrumentation around the actual winder itself is going to have to be upgraded. It's something that we're looking at. However, we can't just pull the trigger on it. The current methods that we are mining are not particularly efficient. We do have small drives or galleries, as we know them. In certain areas, we've had to widen some of them to fit some of the equipment underground. But we are moving to a much more efficient method with the introduction of the mechanized equipment and the installation of conveyors in our belt decline. It's a lot more cost effective, a lot more efficient. In terms of putting info on the company's website, yes, we have said, and I'll say it again, we will have an animated production mining sequence with a voiceover. It'll be my voice, unfortunately, not anybody else. That will give the explanations of how the mining is happening and what some of the infrastructure underground is. Thanks, Paul. I hope I've answered that one. It was quite a long time.
That's great. Thank you very much indeed. And one more, just I think for you actually as well, Craig. After that, the company made a claim to having 2 years of pre-prepared ore just sat there on the surface waiting to be processed. How much ore in tons was 2 years worth, and how much of that ore has been processed since the production commenced?
Okay, well, I don't think we've ever said we've had pre-prepared ore sitting on surface. I think what might have been taken possibly a bit out of context is that the remnant area between 17 and 18 level, the old stopes was open. It was there. It was waiting, and that's the area that we were going to access first and getting to mine. There was no development or any other additional work that had to happen to actually access these areas. It formed part of the initial 300,000 tons. On its own, it's just shy of about 100,000 tons. So with our slowdown in mining in that area, yes, we are going to carry on mining it, but that specific area is going to actually carry on a bit longer.
Thanks, you very much indeed. Next area of questioning is really around funding and refinancing, and probably this is one for you, Andrew. When Atlas requested payment and the company decided to pay in shares, is the 5-day VWAP the previous 5 days to the request, or does day one start from the request?
So the VWAP mechanism kicks in if the share price is below the original 0.24p strike of the tranche 1 bond. And in that case, the conversion is going to be equal to 90% of the volume weighted average price of the ordinary shares on each of the previous 20 days before the conversion would be issued.
Thank you very much, and I do appreciate for those attending, we are running over, but I think there's just a number of questions that we're happy to go through. So on that basis, let me just move on to the next one we've got here. Has the company renegotiated the deal with Atlas in regard to the 0.24 pence?
Any renegotiation is going to have to be announced, but we are continuing to explore multiple options with respect to the refinancing of Atlas. We're conscious not to announce anything until we have a committed solution, and the release of this new mine plan is certainly going to support the refinancing discussions that we're involved in.
That's great, thank you. Do the company know why Atlas are not converting, and what was the sweetener on the run up to Christmas? Is that still in effect?
So they're not. The Atlas bond is, it does have a convertible element, but it's not a vanilla convertible. They have senior security over Baita. So, with that added security, they don't necessarily behave in what people expect with vanilla convertibles. So they to date, they've the conversions have been minimal, and we are still, with this new mine plan, going to actively sort of push for a refinancing event.
That's great. Thanks, Andrew. We've got a question here as well. It says, in the mining plan, it states in layman's terms that there is no need for another placing as CapEx is covered. Does this also cover the Atlas repayments?
Doesn't fall under CapEx, but the monthly Atlas interest payments are covered as part of our budgeting. But the complete refinancing of Atlas is a separate issue. And that's what we're looking at in terms of the entire refinancing of Atlas. That's what we're focusing on refinancing.
Just really following on from that, we were told the December placing was to replace our ability to cover Atlas T1. How are we paying for the widening of the galleries and additional equipment? And does that mean we no longer have coverage of Atlas?
Well, I think it's important to state that we never said that the raise was to cover the Atlas tranche 1 payment repayment. The funds that we raised in December were to cover an equity portion of a debt facility. It was to support an equity debt ratio. We've now allocated these funds post the decision of the bank to capital purchase and working capital, which is what this money was going to be used for in any case. And I think the benefit of applying these funds to Baita can pretty much be seen directly in the new MPV of Baita, taking into account the new mine plan, which is now 107 million versus the 70 million MPV back in November.
That's great. And I think a final one for you there, Andrew. The company, as part of the Tripartite Agreement between Vast, Mercuria and Atlas, claimed that additional standstill agreement was needed in order to put repayments to Mercuria on hold and allow debt repayments to Atlas to be prioritised. However, I cannot find the standstill agreement anywhere, and on that basis, I have to assume that the agreement does not exist. This would mean that the debt repayments to Mercuria would continue, and therefore both Atlas and Mercuria are currently in the process of being repaid from concentrate we produce. This would leave Vast with very little cash in return and would explain why the company has been so secretive over this questionable offtake agreement. To dismiss any theories, would the company direct me to or publish the standstill agreement?
So the Tripartite Agreement refers to the intercreditor and standstill agreement. It's a combined document which has been agreed between Vast, Atlas and Mercuria. It is confidential, but obviously has been evidenced by our Nomad, who's, for us to even have been able to make mention of it in an RNS. And we announced in an RNS the general terms of that ICA and standstill in January 2020. The main terms of it is that Mercuria agreed to a standstill period for the duration of the Atlas facility, and that the remaining Mercuria debt would be recovered from future cash flow via a pre-agreed cash sweep mechanism. And this was all put in place to ensure that the company has the required funding to develop and continue to run Baita.
Thank you, Andrew. A few questions on refinancing, which is, I think, probably more for you, Paul, actually. If we can start with the first one we've got here is, are the operational issues encountered by Baita why the Tier 1 bank would not finance? Is this restructuring you spoke of that was required by the bank?
No, and this is explained on our RNS on the 7th of January, where we made it clear that the decision by the bank not to proceed was unrelated to our current mining activity and wasn't a negative reflection on Baita Plai. And they're very separate. Again, the issues encountered at the mine were subsequent to that, so it had nothing to do with that decision. And as far as the restructuring is concerned, that's an ongoing. It's at the corporate level. It's not at the asset structure, and that's an ongoing process.
Thank you. Next question here really follows on from that. Are we still pursuing the Tier 1 bank? If so, it looks many months to reach credit committee stage. Would we be starting from scratch again? If not, this bank, it was mentioned other suitors are out there. Has this happened to them also?
In terms of the Tier 1 bank, we continue to maintain dialogue. If this option became viable again, we could use the existing due diligence, and with the work done on the mine plan, where there's a lot of strong work done there, we can incorporate that. So it doesn't hold us back in any way. It's not a restart, and we continue to have a number of discussions with other financiers for refinance. So that's ongoing, and with the revised mine plan as we have it, which is a better plan and is more conducive to refi. So we continue with that.
Thank you. What is happening with the restructuring? Now, are there any other blockages to finance being awarded?
This restructuring is not in the public domain, and when we have something to report, we'll go to the market and update the market.
Thank you. Next one we have here is predicted production levels have slipped almost 1 year from the previous plan. How does this affect refinancing?
Production levels haven't slipped 1 year. We've decreased. Obviously, the production has come right down, but it's been more pushed out, and it's certainly 6-8 months, and so or 6 months or so. So first point is not that 1 year slippage. And how does it affect refinancing? Well, as I was saying earlier, the mine plan is better. I actually think we have a plan and cash flow forecast and a product which is more conducive to refinancing. It's more attractive. And the other point as well, which we talked to, was the amount of capex that's going into to mechanising the plant. So there's a lot of cash going into investment, and then there's the intangible, which is the people on the ground. So we've got a good team that we've hired, plenty of experience worldwide in all over the world. So that places us in a much stronger position than we were before, and effectively provides a less risky or de-risk project versus what we had before.
Thank you very much. And penultimate one we have here for you. Shareholders have sold the idea of a financing package with a big name international bank. That to date the company has refused to name. The preconditions of that finance allowed Andrew to finally exercise his options. It also allowed the company to squeeze shareholders further by raising another 5 million via a placing. As you know, that finance package never did arrive, and the only beneficiary of this whole idea was you. Will the company finally name the bank and provide shareholders with evidence to prove that the company did not mislead the market?
I mean, sure, in order to announce what we announced, you have to have documentary evidence that needs to be provided to the Nomad, and these are confidential documents that cannot be made public. And what we've published in the RNS is backed up with detailed documentary evidence. So, it's not selling an idea of a big name. There was a first-tier bank where we were in very advanced discussions.
Thank you very much. And the final one for you here is, what is the financial plan to reduce debt?
It's not really a question of reducing debt. I mean, we have an asset which has good cash flow. Mine plan looks good. That can support a refi. It can it can support an elevated level of debt, and particularly with extended tenor. So it's really not a question of reducing debt. It's a question of reducing the cost, getting the best cost for debt, getting proper good tenor, and to ensure that liquidity is maintained. And as for extracting the value out of Baita, one thing that's very clear is if we can continue to increase capacity, which needs investment, it's not in this current mine plan to increase beyond the capacity increases that we have. There's obviously significant potential to generate additional cash flow, and to be able to leverage it further. Again, it has to be affordable and at good price. That should be in the interest of shareholders. I mean, we obviously get a bit of a tax shield, but also we can enhance returns to the equity shareholders. So it's really not a question of reducing debt; it's getting the right debt in relation to the opportunity.
That's great. Thank you very much. Next subject we've got really is around equity fundraising, and again, probably one for Paul, actually. First question we've got here really reads, primary bid fundraising has proven quite positive in the markets. It's given retail a chance to take part rather than go to a certain favoured few. Is that something the company would look to do on any future possible fundraisers?
Yes, we will consider primary bid should we look for any future possible fundraising, yes.
That's great, thank you. If the company's cash position is stable, and can the board of directors confirm that unless something out of the blue arrives, there is no plan to do further placings?
That's right. We, in terms of the project itself, we have the cash position and the underwriting from the project itself to ensure that we don't have to go for further placings to cover an operating shortfall or a capex shortfall. As Andrew was answering a question regarding Atlas, I mean, there is the issue of refinancing, and what we want to do is to take out debt to refinance Atlas, and therefore protect our position from that perspective.
Fantastic. Will the company state its current cash position?
We can't answer this in this current forum as it's deemed price sensitive. But as I said earlier, we have a cash position, and we have a project that's funded.
That's great, thank you. And the final one we've got here is, what OPEX costs need to be covered with future share placings?
None, unless going back to the previous question, something out of the blue hits us. But no, none. We're covered. Fantastic.
Thank you very much, Paul. Just some more general questions we've got around the business and the opportunity, and I think, Andrew, perhaps some for you here. With copper potential, is there any thoughts to bringing in a financial partnership with a larger miner to deliver both Romanian assets?
Well, put into perspective, Baita is the first of its kind. It's a brownfield reopening in Romania. It's the only non-ferrous mine to be in that position. None of the majors have been able to enter into the Romanian mining space historically, and we believe this will be the benchmark for investment. On the success of Baita, we're in constant discussion with majors, and it's certainly a possibility to work with them on some of our larger pipeline projects.
Thanks, Andrew. Is there any plan to seek a finance deal to develop other projects in Romania and Zimbabwe?
We're in constant contact with funders and other major mining companies for both jurisdictions.
That's great, thank you. And a few more general questions really around, I guess, board performance, which if I can address to both Andrews. Why did you award yourself SARs when clearly the mine wasn't evaluated correctly? Why haven't these been returned?
So the SARs structure, it's an accepted form of remuneration that's based on increasing the share price, which is certainly in shareholders' best interests. it's definitely worth pointing out that the SARs that have been awarded by the company are currently all out of the money. So it's not really a case of returning anything, because they're all underwater, and that includes the SARs that were awarded last year at a strike of 0.198. And the SARs, I mean, certainly align management's interests with those of the shareholders, because it's in everyone's interest for this share price to go up. And the last point on the SARs is that they're not free shares, and they're options which need to be paid for when exercised. That's it.
Thanks very much indeed. Next one we've got here. The market response against the newly published mining plan was unsurprisingly dull. This is a reflection of market confidence of the board of directors' capability and overall ability to deliver. How are you going to address this?
Well, it's not uncommon for a mining plan to alter its mine plan once it's being implemented, because once you're on the ground, it's completely different to what's on paper. Despite extensive history within the mine, you cannot foresee that after you start blasting an area that other parts are going to collapse. So, also what needs to be understood is that we're at the stage in the value curve of a mine where, you've taken out the let's call it the hype of an exploration target, where you get that massive rise, and I'll talk to it later on if we have time. Is, if you look at the value chain and the value curve of a mine, we're at the bottom of the second cycle of the value of the curve. So now we believe the value will be realised upon the successful implementation of this revised plan, and we'll see an upward trend once we get to production and people start to realise that it's profitable and it becomes an investment rather than a speculative stock.
That's great, thank you. We've got another one here, which I think again is for the Andrews. To reduce ongoing operational expenses, why have the board of directors not taken significant pay reductions until BP is fully operational?
The board have already taken salary deferrals. And it's currently a fact that the levels of remuneration are at the lowest quartile with respect to benchmarking compensation and benefits. So it's something that's been sort of clearly benchmarked.
Thank you very much indeed. The next one we've got here as well is, can you explain why Andrew Palia is the correct person to oversee the company's future? So I could ask that one to you, Andrew H.
No problem. Ultimately, Andrew has played a pivotal role that's resulted in Vast becoming the first producing mining company in Romania, in addition to the company holding a pipeline of exciting further assets in Romania and Zimbabwe. In Romania, Andrew, due to his Romanian heritage, his ability to speak fluent Romanian, has a thorough understanding of the cultural nuances involved in conducting business in Romania, and this point is absolutely critical and can't be underestimated. It's been talked about, before by Andrew, that many large multinational mining companies have tried to do business in Romania, and it is a fact that they have not been successful. And Andrew understands the culture when doing business in Romania. He has, his own personal perspective, has access to all levels of government, and this is just something that's not the case for everyone. He's ensured that Vast have been able to navigate the long and sometimes drawn out bureaucratic processes, and he's stuck with it over many years. In Zimbabwe, he's committed many months on the ground to further the advancement of the business there, and so ultimately it's pretty fair to say that there's no alternative person who could assume the CEO role without jeopardizing our standing in both Romania and Zimbabwe. And over the last 8 years, he's committed all of his time and significant financial investment for the advancement of the company, which has involved addressing and dealing with a huge number of legacy issues not related to his tenure. But I think we all believe we're now at a turning point after many years of hard work.
That's great. Thank you very much. I'd like to thank all the attendees today for not only the pre-submitted questions, but the questions that have come through the live event. And there are a number here that the company will review post-event. But I'm just conscious of time as we've gone through an hour 35. Andrew, perhaps if I could just hand back to you. I know you'd like to just touch on that perhaps value curve area, and if I could ask you also just to include in that just a few final words to wrap up before we redirect investors to give you some feedback, please.
Certainly. Thanks, Paul. I'll just pop that slide up. I mean, going back to the previous question about the mining plan, didn't see an increase in value. If you look at the mine value curve that's up on screen now, I mean, we were very lucky. I'll see if I can draw this. Here we go. Drawing. Yeah, in the normal life cycle of a mine, we've avoided all of this. This is where generally tens of millions of dollars go into exploration and reports, and we've gone straight into a brownfield that had quite a lot of historical data. We're now really here at this point in time where we've started the development and startup simultaneously with this new mine plan, especially the development's been accelerated. So we're sitting right at the bottom of the value chain right here, and we should theoretically, and we believe that with the mine plan, we've been reasonably conservative in what we're doing and implementing now, and I think Craig talked to it before. We're already ahead of the development schedule in the first month of implementation, and we will provide updates if we deviate from this plan to the market. And realistically, we've gone out of that speculative stage of a mining company or a junior, and we've gone straight into this new area where we're sitting at the bottom of the value curve, and we can only see it increasing from here based on the results that we're all fairly confident that we can achieve, especially based on the first month's performance within the implementation of this mine. So I think that also speaks to what Paul had said I should talk about, which is why we should invest in Vast Resources, is because we do strongly as a board and as a management team that the true value of the company is not currently reflected in the share price due to historic reasons. There's been a lot of cleanup. The company is, as far as we're concerned, sitting in the healthiest position it's ever been. It's low on debt, it's in production, it's got a pipeline of work, and above and beyond that, we believe that we're going to extract and realise a lot more value out of Baita on a standalone basis. And we can only see that once we do finally manage to implement this plan, which we're doing now, we'll be able to see the uptick in the share price based on performance, which we are very confident we will achieve, and we will be reporting to the market accordingly. As Paul also said, there are another 30 odd questions, and the questions that have been coming in through the Q&A. We're already half an hour over time, actually 40 minutes over time. So we will address those questions, and we will publish those questions and answers shortly on the website or in another forum as directed by our PR company. Thank you very much.
That's great. Andrew, thank you very much for that, and thank you very much to you and the team for updating investors today, and thanks for investors for sticking with us through that prolonged session. I think it was a great use of the time. Thank you all for updating investors today. Could I ask investors please not to close this session, as you will now automatically be redirected to the opportunity to provide your feedback. If you've accessed the meeting from the website, the feedback page will appear in front of you. However, if you've accessed it via the link sent you in an email, just be asked to log in. It does take just a couple of minutes to do so, and your feedback is greatly appreciated by the company. On behalf of the management team of Vast Resources PLC, we'd like to thank you for attending today's session. That concludes today's event. Thank you.